Hey everybody, this is Jose. We are about to get started, a little less than a minute. Let's have a quick sound check as we always do. It would be great if you could go ahead and type a quick hello on the chat box. It's a good way to start the session, and then now I know you hear me. So I know sound is good and we are ready to start on time, which is 30 seconds from now. So please go ahead and say hello on the chat box so we can start on time. Thank you so much. Almost ready to get started here. Okay, 5 seconds to go. Almost ready. Here we go, top of the hour. Welcome to the session, everybody. My name is Jose Blasco. Today is June 16, 2022, and this is options trading. So we're going to be looking at the options markets as we always do. We're going to be looking at market opportunities. A lot of things are happening in the market, as I'm pretty sure you are all aware of. So we have a lot of analysis and discussions to be done today. It's going to be, I would think, of a pretty interesting session today. Before we get started, as always, in the upper left side of the screen, I am highlighting the financial disclaimer, so please read it carefully. This is important information. It's, as I always say, fairly short, so I'm counting on you guys to read it completely as you are ready to begin with the session, okay? Great. How are you, Jeff? It's good to see you. Everyone, good to see you all. Very nice. Cool. Okay, so as we're getting started, by the way, you are probably noticing on the bottom part of the screen, there's a little bit of a message, a special message that I wanted to have out there for you guys. We are very excited. We are launching in July our crypto course. It's 7 days, it's online. And of course, there is a promotion on the launch. You probably have received an email if you are part of our community, and you know what to do to subscribe. In any case, if you haven't received the email, or maybe it's in your spam folder, so you can just use the link that you can see on the screen, tradewithufos.com/courses, and then you click on the crypto course, and you will see that there is one option that is discounted by 60+%, which coincides with a pre-sale, pre-launch, if you wish, promotion. Okay. Cool. So I'll turn the ticker off. We don't need that for the session. I just wanted you guys to be aware. Again, as I said, we are quite excited. Anyway, moving seconds to the second step. As always, I am showing you the questions page, which is accessible by typing tradewithufos.com/Jose. And when you scroll down all the way to the bottom, in this bottom section, that's where you can find the questions. Sorry, the question section, which is a very convenient place where you could type questions so you get answers. And if the answers are not found, then you can just click on the green button and type your questions. I always recommend to adding screenshots of your charts or anything that could be supporting materials to make sure we understand your questions well, so we can give you powerful and complete answers. Okay. So make sure you do that. Okay, and finally, we are now moving into the real-time charts to look at the market and begin our session and our analysis. Mark, how are you, my friend? Good to see you. So first thing first, the S&P is down by 3.2% after a collection of multiple days falling pretty hard. When I say pretty hard, I mean pretty hard, not as a subjective impression, but pretty hard because we reached a maximum distance measurement on the autoclimate of 2.58, where two standard deviations of a maximum extension on climate would be 113. So we kind of more than doubled than that. So it's kind of like the market has stretched to a level of, let's call it 4 standard deviations, if I could just oversimplify it a bit like that. And therefore, again, we are talking about moves that are very serious moves to the downside. I have to say I'm not surprised, and this is not a comment, trying to brag about anything. But basically, we were analyzing the markets last week. We talked about it, the fact that the climate was starting, the fact that the implied volatility of the puts was greater than the calls, the fact that the prior blue climate never got to get confirmed. It was unconfirmed all the time. The fact that the prior red climates exceeded probabilities, the prior blue climates didn't manage to develop. all of these basically were signs, clear indications that we are in a bear market. And of course, there are multiple ingredients from a fundamental point of view. Yesterday, of course, we had the report of the FOMC meeting, and for the report where it was said that interest rates are raised by 0.75%, which is something that obviously is very good for the dollar. And the stronger the dollar gets, you know what happens to the other markets, right? So they go down. Why? Because you need less dollars to buy the same thing. Why? Because the dollar is stronger. So it was a, if I could use the term obvious, which is never in trading, but if I could in this case, you get what I mean. Just to keep it simple, it was quite obvious that this was a real possibility, and that's why I even joked last week saying that, which by the way I forgot today, I would change the background of my camera to red because of that. Okay, so certainly we are in front of a market condition which is very, very serious. Having said that, it's nothing yet. So if you look at the top of trading that we have, which was around 500, and the current price, which is 366, if you do the math, we're talking about 25, 26, 27%, something like that from the highs. So we can go easy another 20 plus percent before we change from a condition from a bear market to restarting a bull market. So that's where we are at. And again, I'm not saying this is going to happen. I don't want to predict so far. But from what we can see now on the daily time frame with the auto climate and the implied volatility of the puts greater than the calls, there is no sign at this moment in time that the market is going to go back to blue in a very healthy manner. Now, should we expect the market to go back to blue soon? Yes. Why? Because the current statistic shows 5 out of 3, and the max distance is 258 out of 113. So statistically speaking, the market should revert back to the mean and go back a little higher, maybe to give us, 1, 2, maybe a bit more of the blue color to then go back to red. That would be my expectation at this moment in time. So we should see a pause at some point. But of course, today is the day after the FOMC meeting. It gave a lot of hope to probably less experienced traders, and basically the market today is proving what it really wants to do. Okay, so I would not be surprised that this may last a little longer and then go back to that few days of blue to go back to red, unless we start having other readings on the options data, which at this moment in time are clearly bearish. Looking at the VIX, we can see the VIX went back up to 33%. So yesterday the VIX that was trading in the 30 plus went down all the way to this green UFO at 28. And from 28 it went up to 35. So this is a 13% increase on the VIX. That's again a very powerful move. And when we look at where is that implied volatility coming from, so let me go back to SPY, you will see how it's coming from the puts. Look at the real-time implied volatility. This is the day measurement, because on the right I got the 3-day average. On the left I got the 3-day average, but here on the right I got the real time. So notice how the put implied volatility is moving away from the call aggressively. So again, there is a lot of put buying, a lot of call selling today. Again, more sellers coming in the marketplace. With this type of options data, as we discussed a few weeks back, you understand if you got buyers or sellers in the market. What you don't know is at which price point. That you would understand a bit better if you were to look at open interest in the options data. You would look at UFOs on the chart. That you would understand a bit better. But by only looking at the implied volatility of calls and puts, you basically get to understand if there are buyers or sellers in the market. And right now, it's clearly seen we have sellers in the market. So the market may continue falling. And if it rallies, what would be expected is another push to the downside, even though we may need to take a little bit of a breather with, 1, 2, 3 blue dots, whatever. But, that's the market environment that we have at this moment in time, which, of course, like anything in trading, it could change in an instant. And next thing you know, next week when we meet, we may have a complete change of environment with the blue line way above the gray line, and everything has changed. Why? Because maybe it was deep enough, and all the short sellers took their profits in a way that was very aggressive, and they turned the market around. Because to close the short, you have to buy. So again, we don't know what's going to happen, but so far with what we have in front of us, it's a market condition, for us to assess that information and basically have this bearish mindset, which I am sharing with you today out of basically utilizing the tools and processing the market data. Okay. My friends, if there is any question that you like to ask or comment that you like to add to this conversation, go for it. Okay, do not be shy. I know that some of you are attending the sessions in a regular basis, and I know you are not shy. But there may be some of you that are newer, or maybe you attend the sessions all the time, but you've never seen such a strong bear market, and there are things you want to ask, or so just feel free, guys. We are here to help, and therefore this is the time for you to speak up. Okay, so do not be shy if you have anything to say or to ask. So again, what should we do in a market like this? Well, again, because the climate is down, and we want to be a seller, but since we are dealing with 5 out of 3, right? So being a seller now is basically being late to the party. So you got 2 choices. Be very aggressive. How are you, Ahmed? Good to see you, my friend. You have 2 choices. Be very aggressive. Thank you, Joanne. You have multiple choices here, right? So be very aggressive and start planning on buy opportunities, which, again, it could make sense to do that if you are aggressive, as I just said. You've seen me do that before. I did that with Verizon, for example, which is a trade which is making money. Even though the market has felt aggressively, Verizon is still making money. Why? Because we use stocks that were in a strong sector. We were using UFOs way below price. We were selling puts price below price to give us to create a buffer that allows us to be wrong by a certain amount, and then we bought calls in exchange for that premium to create positive deltas, and that trade worked well. Again, we will review it in a moment, and we can certainly build trades of the same sort. Now, having said that, it's going to be more difficult this time compared to a few weeks ago. Why? Because when you look at the groupings, no matter if it's mid-term or long-term, and you look at the strength, I mean, how many of those groups are blue? You got oil and gas, okay, but notice how we went from blue to neutral, right? And everything else, this one is blue on the long term, but is red on the short term. So again, this is the picture of a bear market, okay, which again could change in an instant. Okay, we need to be adaptable, dynamic. We don't want to be stubborn just because one day you did market analysis. This used to happen to me when I started trading. You do market analysis one day, you are totally convinced and clear on what your conclusions are, and now you keep that in your mind for too long. The market changes and you're still thinking, yeah, I know it's going up, I know it's going down. No, we need to be adaptable. So whatever we conclude today, we need to be flexible and adaptable. And if that changes or we are proven wrong, I am proven wrong, so I'll take it, okay, and don't fight it, and don't fight myself or my beliefs or egos or whatever that is, because in the end we are human. We need to put that on the side and be adaptable, okay? But having said that, look at how many red colors we got here compared to the blue. So it's going to be difficult to do trades like the one that I did with Verizon, where we had an utility sector that was in the blue, and that is how the utility sector now is in the red. Okay, so it's going to be difficult to find those opportunities, even though we could. Okay, and certainly they exist. Okay, and we can even get a bit more aggressive than that. And as long as you do it with good risk management, nothing wrong with being aggressive if that's you. Then another approach is, of course, volatility is very high. So what can we do? Let's do our own condors. Let's do non-directional strategies made of selling options. Why? Because we expect a change of direction. So, the market is likely going to be ranging, going from an extended down climate to maybe some sort of a blue climate to go back to a down climate. So we would expect some sort of a range of price to happen in many stocks. And on top of that, implied volatility is high. So then that's another good candidate, which I'm going to be exploring later in the session on the type of trades I would like to find in this type of environment. Now, what's my challenge? My challenge is that because the market has moved aggressively, good news, I got plenty of premium in the options, but bad news, when I run my historic volatility measurements, okay, notice that even though the world has been kind of like ending on the S&P, notice how the red line is within the blue lines. We don't have the red line above or beyond the blue lines, meaning that the historic volatility, meaning the real price movement of those stocks, it's fast. And because it's fast, then the statistical ranges are wide. And if the statistical ranges are wide, many of my own condors, even though I get plenty of premium, many of them are going to be discarded because of lack of premium, given the minimum requirements that I have programmed in the spread select tool with the filtering conditions that we have. Of course, if you go for low premium, then fine, you'll find many trades. But if you want a greater reward to risk ratios and things of that sort, then probably not. Okay, so we're going to be exploring all of that, and basically what I'm trying to anticipate and basically share with you as a kind of like, just sharing experience really, is the fact that when the market is that extended or stretches so much, so basically it's difficult to trade. And the reason why it's difficult to trade is because it's kind of too late. It's too late to get short. It's difficult to get long, and then to be non-directional because it moves so fast already. So then the ranges are probably too wide to have premiums that justify enough the risk of those trades. So it takes a bit more patience, research, going from setup to setup to setup until you find a trade that you accept. There are always trades in the market. Come on, we got like close to 9,000 stocks. So normally you end up finding trades, and you know me, I'm very, very demanding with the trade setups. So many times during the sessions also, because I want to really show you clear examples so you can replicate these practices when we are not running sessions live and you are practicing all of this by yourself at home. So I love to be very demanding, very perfectionist, if you wish, which makes it even more difficult for me to find setups at times. But again, with patience, you find them. Okay, and this is what is very required in a market environment like that. The market is violent. What you don't want to do is to now act emotionally, and whatever looks like a trade, you're gonna take it because it may slap you on the face very bad. Okay, so we gotta. I mean, no matter if the market is quiet or gentle or aggressive and rough, it doesn't matter. We should always follow our rules and be disciplined and everything else. But in a condition like this, often what happens behind the scenes in the subconscious mind is that psychology, emotions kick in. We don't realize it, and then we make up trades and we do things. So again, everybody needs to keep that in mind and stay and remain as a patient trader. Very important in this environment. And by the way, while the movie is not a joke, and I even said that I have no problem to change my background to be red color instead of blue. To be honest, it's 26%, 27%, something like that drop from the highs. I mean, it's not the end of the world. We've seen worse than that, isn't it? So 26% drop. I mean, yeah, fair enough. It's not a small move, but it's not the end of the world. So there is no reason really for lacking patience or things like that, right? We always need to keep ourselves cool. One of the situations, if I can share another piece of information here, I need to get into options data, but hopefully this is useful. One of the biggest challenges I have as a trader since I trade was actually in 2020, which is not that far away from now, and that was during the pandemic. And when the pandemic started, not when the pandemic started, but when the market started realizing there was a pandemic and the markets went crazy. I remember there was one day, it was in March 2020, where the US market was about to open. The futures went lock limit, but the S&P ETF didn't. So next thing you know, you have the S&P ETF about to open like 10% lower to where the futures were. That is a major arbitrage opportunity like I've never seen in my life. It was basically free money to go long the S&P ETF and go short futures. It was basically free money, easy, but I could not trust my screen. It was too good to be true. I kept rebooting my computer, resetting my data, deleting market data, hard drive information to reload market data, make sure what I had on the screen was real. And it was, but I still didn't trust it. So sometimes when the market are moving very, very quick and the very good things are actually being produced, maybe you don't even trust it. It's too good to be true. And then you don't act on it. But you know what? As a trader, I think that it's the most important ingredient for success is discipline. One of the most important ingredients for success is discipline. And therefore, I'm proud of the fact that I missed a trade because I didn't, overreacted or got overexcited because it was real. It was really free money. I mean, what an arbitrage opportunity! Unbelievable. Like in the old times before markets are electronic, you would see that in exchanges. Floor traders would take advantage of that many times. But since markets were electronic, and when we talk about the S&P futures or the S&P ETF, which is the largest equity market in the world, that doesn't happen every day, right? So it was incredible. But again, I'm proud that that day, as always, I was disciplined and patient, and if I was not sure, I didn't act. Okay, so make sure you keep this kind of mindset, this kind of thinking. Maybe you want to do, if you are a trader who does visualization, meditation before you trade, or when you prepare yourself for trading, you may want to add some of those thoughts, especially when you are dealing with a down market which is aggressive. Because again, especially for the ones of you that may be trading a bear market for the first time, so it may be challenging, and you need to keep your emotions under control. So I wanted to add a little bit of market psychology or trading psychology, if you wish, as we start the session, because obviously, this is serious stuff. Okay, cool. Anyway, so let's now review our positions. Okay, so we have Verizon. Look at the midpoint. So Verizon is currently producing a net result of $45. If you recall, if you look at the chart of Verizon, which I'm going to show you in a moment, so Verizon went down big time. Okay, it went below our entry. Okay, but thanks to all the management of this position that we did, so worst case for this trade is to make $36, and that's the worst case, and it's looking like we're gonna make $36. This expiration date is July 15, so we still have time to go, and never know, maybe on July 15 we did hit 55, which is when you will get the maximum profit of the trade, which is $286 per contract. It's not looking like that at all. So it is looking like we're going to make $36 per contract, even though this market went against us. So this is the trade I was talking about. This is a trade that we entered on that particular date. That was April 27. Okay, Verizon went way aggressively against us, but as it came back somewhere around this place, we did some tweaking on the trade, giving the trade a second chance, and now the market went against us. Again, we are below this horizontal line, which was our entry. So we should be losing, but guess what? We are guaranteed a profit of $36 per contract no matter what. So again, great action. It was aggressive because on April 27, the S&P was doing this. Okay, so the S&P was falling hard. We were dealing with levels of max distance that were not a joke. I mean, the one time after we have surpassed these levels is now. Okay, the prior climate that had that was that climate, and that's when we entered Verizon. So, nice one. Okay, and that's the concept of, if you're gonna be aggressive, build yourself a buffer that allows you to be wrong by a certain amount, so you can survive, problematic situations in the market. Okay, so nothing to discuss about this trade. We talked about it for multiple weeks. We cannot lose on this trade. So I won't add any comment. If any, I'll try to build a similar trade later, and if I accomplish that goal, which is going to be difficult to find, I'll go deeper into the whole rationale. So if you missed that session on April 27, so at least you will get it now. The next one is Mastercard, okay, which Mastercard was a trade that went against us all the way, and now, again, thanks to the managements that we have done and everything else, same story, we are back in business. So we enter this trade on this particular day. That was a bearish trade. We were expecting Mastercard to fall, but instead it went against us very, very strongly, which, by the way, when something goes against you very strongly, in a way is very bad, because you see the P&L going away from you very quickly. But in the other hand, the faster it goes in one direction, the less sustainable, and the more likely it will move in the opposite direction aggressively too. And that's what happened. Okay, this is what happened. And again, the target for this trade, the original target was located down here. So we are on our way for the target, but should we call it a day and get out of this trade? Sorry, I just clicked on the wrong place. So let's take a look at the position itself, because we did some management of this trade. Okay, so this trade that was initially a credit spread, a bear call spread to be precise, so was converted into some sort of an iron condor. Okay, not exactly an iron condor, because you can see the more it falls, the more you make, right? But if it was to rally back up, of course, now you will lose some money, right? So now, what's the maximum profit of this trade? The maximum profit of this trade is 65. How is currently this trade making? 59.5. When is that trade expiring? In June 17, which is tomorrow. So what is the likelihood? I mean, the break-even point of the trade is 333. The current price point of this trade is 309. So in other words, if that stock moves by 10% up between today and tomorrow, then we will break even or lose some money. If that stock remains wherever it wants to be below 333, then we're gonna make the full profit, which is 65 versus 59. So given the fact that we have 1 day to go, my suggestion for this trade from a trade management point of view is just to leave it alone. Leave it alone. That's it. Done. The probability of ending up with a proper profit is very high. And if you try to exit now, it's a problem, because given the fact that there is only 1 day to go, liquidity is truly going away. And you can see that in the form of a very wide bid-ask spread. Look at how much money you're gonna leave on the table if you try to close that. From 7 to 34, from 4 to 26, from 22 to 23, from 19 to 21. Those are hundreds of dollars of difference between the bid and the ask. That's a big problem. You're gonna get hurt. You need to pay on top of that for commissions to get out. So, given the fact that, probabilities suggest that you'll get up to here, and the break-even point is all the way there. So we're gonna just leave it alone, and very, very likely into tomorrow close, cash our $65, and that would be it. Okay. Now, is there any risk of assignment, exercise, or things of that sort? So let's re-summarize this trade, because that's gonna happen tomorrow. So this trade, starting from the call side, is made of owning the 335 call long and 330 call short. And on the bottom part, we are short. Sorry, we are long. Let me write it next, so it's gonna be easier to be understood. We are long. We are short the 332.5 put, and we are long the 330 put. Okay, so it's almost an arrow butterfly with $2.5 difference instead of being properly aligned. It's something weird. Okay, but at the same time you can see the P&L, the risk profile. I meant to say the P&L graph. So you can see that the P&L graph, it's very, very similar to a vertical spread, right? It's how we started. By doing this trick, the only thing that we did is to reduce the risk of the trade when the stock went against us. Okay, so now we are back in business, and therefore, by leaving this alone, we will make those $65. Now, risk of assignment and exercise. Well, on the call side, nothing. Why? Because we are trading at 309. Let's pretend we are going to be at 309 on Friday expiration. So we are indeed below 330. So what happens to both calls? They will be both out of the money, and therefore they will expire worthless. So that's it. That's done. And what happens to the puts? Well, because we're going to be below 330, right? So they will both be in the money. And because both are in the money, so the 332.5 will be assigned, and the 330 put will be auto-exercised, which basically will get you in and out automatically, and that's it. You'll be out of the trade. So on the day after expiration, on the Monday after expiration, you will look at your account and you will have nothing. You will not have Mastercard shares. You'll be in and out because you are assigned and auto-exercised. Now, note of caution with certain platforms, especially TradeStation, where they charge you $14.95 per contract for assignment or exercise. So you're going to have to pay $14.95 times 2. With many other platforms, I would say with the majority or almost all of the other brokers, they don't charge you for assignment or auto-exercise or exercise. And therefore, basically, you exit this trade, you would make $65 of profit, and that profit would be yours. No commissions would be paid when all those options expire, no matter if they are exercised or assigned, in those cases. Okay, so nothing else to comment on Mastercard. I'd love to get some confirmation from you guys when it comes to Verizon. You never said anything when it comes to Mastercard. Is it all understood, especially when it comes to Mastercard? I know some of you are running this trade, and we all know Jun-16 is tomorrow, so this trade is expiring tomorrow, and therefore I want to make sure it's all well understood, and I don't have anyone that tomorrow is like, oh my God, the options are going to expire. Those options are in the money. What do I do? Right? So hopefully this is well understood. And if not, let me know. And if it is well understood, I would really love it if you guys can go ahead and confirm. Thank you for that, Mark. Thank you very much. And we're going to move to Delta Airlines, okay, which is the next trade that we need to explore. So let me bring a race graph first of all. Okay. So what is Delta Airlines? Well, Delta Airlines is our double calendar. Okay. And what happens to this trade? Well, one good thing and one bad thing. Thank you for that, Jeff, as well. What is the good thing that happened? Volatility is increasing. If we look at the implied volatility for Delta Airlines, which I'm loading on the left, so we can clearly see we went from levels of 40 something to 59. So what's happening to the risk profile? Notice how we have a very, very interesting green area above the zero line. Very nice and very interesting green area above the zero line. That's nice. That's cool. That's perfect. That's what we need. Wonderful. Okay. Now, what's the issue? The issue is that while that's happening, we love this to happen a bit later. Okay. We are using July 15 expiration, which coincides with the earnings. And therefore, we would like that raise of volatility to happen a bit closer to the earnings, which in this case is happening like 1 month earlier. Therefore, we have not rolled enough of the weekly expirations. And therefore, we are now finding ourselves, with the stock having gone down, and we are finding ourselves in this particular price point, which is producing a negative P&L of negative 117 per contract. Not a big deal because we're about to roll and we have multiple more weeks to roll. And every time we roll, we're going to bring in more premium. And as we bring in more premium, the risk is less. The net debit of 154 will be less. And the lesser the debit, the less the risk. And we are keeping that green area in between, which, hopefully the stock will rally back up a bit more, or volatility will keep increasing, and then we will end up in a profit. But at this moment in time, price went down a bit too aggressively to my taste. Of course, we cannot control it, and that's why we are in that red portion of the screen at this moment in time. Okay, in a normal case, because we are dealing with very wide ranges. Okay, I mean, if you recall when we were building this trade on that day, the statistical range on the current date, okay, this current date, the statistical range, we have bought the prices up to $34. And guess what? We are trading at $29.89. That's like an additional 10% down. So Delta Airlines got killed, absolutely killed and hammered, which is great from an implied volatility point of view, but it would be great to be a bit more centered in the range, because now when we do the rolls, we will not need to deal with in-the-money options, and we'd be able to roll not only the put, but also the call, which the call side, you probably remember already last week, I was having problems to roll it, and I could not manage it. And this week is going to be the same story. Okay, take a look at the call side. You may recall, funny, I said call side and recall. You may recall that last week we placed an order with an activation rule for the order to be triggered on Monday when the market opens to sell the 43 call, but I was asking a minimum of 15 cents. Well, guess what? That order is still there waiting. That call is trading at 1.5 cents, and it's been under 15 cents for the whole week, and I have not got filled on the call. Notice how I have -1 put, +1, but my minus call is still 0. I have not got filled. Okay, so guess what? It's not going to happen. I'm just going to cancel it. Okay, well, actually, I'm just going to do something later, so I'll leave it there for a moment, but I will cancel it. You will see. And the problem with that call is that since the market went down aggressively on Delta Airlines, so if I try to sell a call, I'm going to have the very same problem. Okay, maybe a bit better this time because there is more premium, but still, I would be shocked if we get 15 cents. Okay, I don't think we're going to get 15 cents. Okay. Yes, Jeff, exactly. So now let's start working on the 36 put. Okay, and do we roll it or not? Again, the answer is: do we have distorted Greeks? Okay, so let's take a look. So we are looking at Delta Airlines. We are looking at this week and next week. We're looking at one strike, and the one strike we care about is the 36 puts. Here we go. So what are we doing? What are we dealing with, right? Here we go. So on the front week, okay, we had 7 contracts traded, but this is interesting. what's happening, we don't see it here, but what's happening is that the bid size or the ask size, one of the two is zero, and therefore, because that's the case, the system cannot calculate the theta. So if I was going to compare that theta with the theta from the next week, and I was going to see if my Greeks are distorted or not, but guess what? They are distorted. How do I know? Very simple. Because I cannot even calculate the Greek, so it's distorted for sure, right? So in other words, it's time to roll. Okay, it's time to roll. Now, the roll that we're going to do this week, really, I would expect it to not to help much. Why? Because again, we are very deep in the money. I mean, the current price of the stock is trading at 30. The strike that we are using is 36. So we are $6 in money in a stock or a strike price that is 36. So this is kind of like, 15 to 20% in the money. That's a lot of being in the money, right? So I would assume that because the option is so deep in the money, the amount of extrinsic value that those options will have is very limited, and therefore probably the roll will not be too productive. But we have to roll. We have to. Why? Because if I don't roll, I will be assigned long stock tomorrow. Would that be a problem? No. Why not? I mean, we talked about it in prior sessions. The reason why it would not be a problem is because as long as I am, as you can see here, long the 36 put that expires in July 15, and then I get assigned on the short 36 put, and therefore I am long 100 shares of stock that is put to me at 36. So guess what? I have my risk under control. I don't acquire unlimited risk just now because I own shares. So I'm not concerned about that. There is an impact on margin and capital allocation, if you wish, or capital requirement to be in the trade. That's problematic, or could be problematic, even though I would assume you have extra capital in the account when you trade. So maybe not so problematic either. But what's the point? If I get the shares and I own the put, so how do I add more time decay to the equation? How do I add more premium? How do I benefit from an increase in implied volatility? So I cannot do many things anymore because I'm owning the underlying asset, which is not an option. So I want to avoid the ownership of that asset as much as possible. Okay, and therefore the way to do that is to roll. Okay, so let's take a look at what would happen if I roll that 36 put. This one, the one I'm short, the one that is in the money, ITM. So if I roll it, probably I'm going to roll it for very nothing, 5 cents. Okay, so like I really dislike this. Okay, but I have to. Okay, and again, let's say the stock is trading, and you have seen me do that, by the way. Let's say the stock is trading at 35.5, right, or 35, or something like that. Maybe I wouldn't care to be assigned. Why? Because then on Monday I can close the shares and then sell the put. And what's the benefit of doing that? Well, the benefit of doing that is that if I happen to be unlucky and the stock drops, it's the same because I own the shares and I own the put. So it's the same. I'm protected. But if I'm lucky and the stock rallies, I have a little gap up on Monday. So then I can close the shares for less pain and sell a put for more premium. Okay? And that would help the trade. So if the price of the stock was relatively close to the strike price, which is 36, then that'd be okay. But what's the problem? The problem is that we are so far down, trading at 29.88. So, which even if there is a gap up on Monday, I mean, unless the gap is a 10% gap up, really, I'm not gonna create a significant advantage by owning the shares. And when I sell the put, I will probably get paid very, very little. I mean, I will get paid a lot because it's in the money, but from an extrinsic value point of view, right? If I go back to did I close the option chain? I think so. So if I was to go back to the option chain and I look at the 36 put, right? So notice that this market is trading between 625 to 610. Let's do some math. Why is my calculator not loading? Okay, no, took a very long time to load the calculator. So the midpoint between 625 and 610, it's 617, right? So if I use that number, okay, and I look at the difference between the price of the stock and that strike price, right? So the price of the stock is currently 29.93. You can see that here on the upper part. If I compare that number with the strike, which is 36, right? So 36 minus 29.83, that's 607. 607 minus the premium, basically it's 10 cents of extrinsic value. So there is extremely little extrinsic value because there is extremely little delta, or in this case, a lot of delta because it's very deep in the money. And because there is a lot of delta, just like if it was very little delta, so the amount of extrinsic value is very little because there is very little uncertainty attached to that option, since it's so deep in the money. So doing it now, doing it Monday, it's going to be about the same. And then I need to do 2 trades and pay 2 commissions and all of that. So basically doing the roll now, it's kind of a waste of time because I'm going to do it for 2 cents. Let's try to see if I get it for 5. So it's a waste of time, but if I don't do it, it's even more a waste of time. Yeah. So I need to give this trade the opportunity to survive another week. Hopefully the stock goes back higher. Hopefully volatility keeps rising. Okay. And if that's the case, then we're going to be able to sell a better put next week and keep helping the trade, especially as volatility is rising and may keep rising towards earnings. So then, we should be able to, at some point, sell puts with a bit more juice. Okay. Also, by the way, if instead of doing that today, you had checked, let's say Wednesday, Tuesday, because it's so deep in the money, you may have seen distorted Greeks sooner. Not sure if any of you were watching it. I'm not sure, Joe, if you are with us. I believe you were in this trade, so not sure if you were watching it. But if that's the case and you have acted before, maybe you got a little bit of a better roll than me for only 5 cents. But in any case, I'm just going to do it because if I don't do it, I put myself in a worse position. Okay. So let's see if I can get filled. We got 0, 5 cents. Look, to make this very quick, I'm just going to replace it with a market order. Please don't do that. You see me do that all the time for convenience purposes. Make sure you use your limit orders. You negotiate your entries and your exits. I got 3 cents. Okay, great. So that's it. Okay, so I got my roll. Okay, and now I'm going to be able to input that and see what it is. Okay, so basically I lowered the risk of the trade by $3. Kind of waste of time. Okay, but now I give the trade another week to do its thing. Okay, and again, we are dealing with a very, very severe market movement, which is obviously the risk that these trades could suffer, which in this case is what's happening. Okay, so compare spreads. We're gonna copy the primary. Okay, copy the primary. I'm gonna edit the spread, and what we just did is for the put, which was trading at 133. So we added 3 cents. So now it's 136. And instead of July 15, so now we are dealing with July 22nd. Okay, this is the option that we just created. So by doing that, notice how, basically from the risk side, we basically made it better by, give me a second, guys. I did the opposite. I'm like, this cannot be. Sorry, guys. July 15, that was silly of me. 133, here we go. 0.72 and June 24. Yeah, I don't know what I was thinking. Sorry for that, guys. So yeah, so my point is, notice how we are reducing the risk by just tiny bit, $3, okay? And notice how there is still this green area, above price, that if the market rallies, we're gonna make a profit, okay? Now, I wanna talk about the call, okay? I believe probably I rolled the 36 put Wednesday for 15 cents. Well done, Mark. Well done. Well done. Well done. Perfect. I love it that you guys are on top of those trades and you are doing the right thing. Fantastic. Now, what about the call? So again, if I look at the call, right? So let's look at the 43 call. So if I look at the 43 call, it's currently trading at 3 cents. Okay, there is not even bid. Okay, so again, same story, just like last week. Probably I won't get filled. So what would I do? Same story. I'm just gonna edit the order I had from the prior week, cancel replace. Instead of June 23, we're gonna move this to June 24. Okay, and I'm gonna leave it as 15, and I'm gonna replace my condition. Okay, which is going to be to send the order on Monday 20 at 9:33. Save, confirm and send, and therefore that's it. The new order has been replaced, is right here, using June 24 instead of June 17. Okay, so we missed getting filled on the 17, so we are now trying to get filled on the 24, which next week will confirm if we got it or we didn't. Now, from a simulation point of view, two things, because the simulation I have here is not accurate. Why is not accurate? Well, because here it says that I own the June 17 call, June 17 43 call for 37 cents, which was my original fill plus 15. But guess what? I never got that call. So what I'm going to do is I'm going to move to 24 without adding any value to the fill price, and that would simulate or graph what would the risk profile of my trade be if I was to get filled on that trade. Okay, and as you can see, so the risk graph, still produces the green zone. Of course, it looks a little lower now, obviously, because we got nothing from the put below and only 15 cents from the one above. So it's working against us. But as it goes back towards the green zone, you'll be able to roll the put and the call and the put and the call multiple weeks, and therefore the trade progression is totally normal. And by the way, if volatility was to increase, obviously everything goes up. So we are okay. The only thing that we are not okay is with the fact that Delta dropped very, very, very aggressively. I mean, if we do the math, since we entered that day, we entered at 39.54. Out of curiosity, let's do the math. So we entered at 39.54. The current value is 29.8. Out of 39.54, we're talking about a 24% drop since we entered. I mean, the whole S&P dropped 26, 27 since the highs, which was all the way here in April. This is only since beginning of June 1st, right? So again, major drop on Delta Airlines, way beyond what statistics would have suggested, but it happened. So again, we are defending the trade in a proper way, and we've seen it before. That a trade goes against you, and then we were able to manage it and ended up with a better ending. Okay, either a smaller loss or a profit. In the case of Mastercard, that was a great example. Okay, so that's it. I'm just gonna place that last evolution on our My Positions panel so we can track it. And I will look at the chat box, and then the remaining time that we have will be to try to find at least one trade. Let me see. What if we close the put calendar? Jeff, if you close the put calendar, it wouldn't make sense to me, because you will be left with a long call which is far out of the money, which is likely going to do nothing until the end of the trade. So basically, you are giving up on the whole trade. So why don't you just close it all? Okay, and it doesn't make sense to me to close it all either, because we are going through the trade live based on a scenario which is possible, and we are managing that scenario the way we should manage a scenario. So this trade has moved too much, when it comes to what the statistical range was. That's bad. That's why we are with a negative P&L. But at the same time, worst case is that we're going to end up with a risk that was predefined when we entered the trade, which is now less because we've done 2 or 3 rolls. I think this week is the 3rd roll, even though this week roll only added $3, which is nothing. But we are managing the trade the way it should be. And again, just like, the fact that a trade goes against it doesn't mean it's the end of the world. Look at how bad Mastercard went against us to now end up with a profit. So the same thing could happen with Delta Airlines in the complete opposite direction. That stock has dropped 24% in no time. Next thing you know, you may have this massive bounce in the opposite direction, and now you're in business. Okay. So again, there is no reason, unless you want to give up on the trade for whatever reason that was not in the original plan. There is no reason to give up on the trade, and closing the put calendar is a way of giving up on the trade, because you will be left with an out of the money call that basically got no value already. So what would you be left with that? Okay. Cool. Good question, Jeff. Good question. Okay. Hopefully it makes sense. Joe, since the short call expires tomorrow, how can it be rolled? Well, we don't own a short call. Okay, we don't own a short call, so there is nothing to be rolled because we don't own it. Now, now that I'm saying that, I think I remember last week you said, Joe, that you rolled the call earlier than me, and therefore you got the call. So if you own the call, I mean, think about it. The call is all the way up here, where the stock is all the way down here, right? So what's going to happen to this call tomorrow on expiration? It's going to expire fully out of the money. And if you roll it now, you're going to have to pay $1 or $2 to get out, plus commission. And if you sell the new one, you saw it was trading for like $3. So why would you pay $2 or $3 plus commission to get $3 off on the new call? Doesn't make sense. Rolling it is going to basically make you lose money instead of make you make money. So if you own the 43 call short, right? Given the fact that this is not a naked short call, it goes together with the long 43 call that expires in July 15. So I would just leave it alone and let it expire. So that way you don't have to pay commissions to get out, and you keep the maximum premium. And then do the same thing I've done, which is place an order at 15 cents. So hopefully later in the week there is a rally, and you can get filled on a 43 call at 15 cents. Okay, which is going to be difficult next week. Probably we need 2 or 3 weeks or whatever, because it's very far. But that's what we have to deal with, and therefore rolling the 43 call would not make sense at this stage. I'm going to take a sip of water, and please, Joe, if you can confirm that you're with me, you got me, and it's all clear, it would be great. Okay, so what's the S&P doing? About the same. Got it. Very good. So what can we do here? Okay, well, putting together an Iron Condor, I won't have time. So I'm going to look and see if I can find a trade which allows me to be bullish, aggressively bullish. Yes, perfect, Joe. No, not an issue. I mean, it's normal to, in a way, get confused at times with so many things that we do and so many possibilities with options. So that's why I'm so glad you guys are asking questions, participating, practicing the trades, because that's basically, I get confused myself at times. It's normal. Sometimes you even make a mistake and click the button with an order with the wrong symbol and things like that. So these things could happen. Okay, so it's important to always review and definitely ask questions to clarify. Okay, but I see now it's clear, so that's fantastic. Anyway, so looking for opportunities to be bullish. So obviously it's going to be difficult to find. Got you, Joe. Understood. So it's going to be difficult to find because one of my criteria would be to find strong sectors, okay, in the long term. On the short term, everything is going to be down, okay, and no need to check. If I was to do strong up in the midterm and long term, let me delete everything. Okay, yeah. So if I do that and I search, I should get very little or nothing exactly. Okay, why? Because nothing is strong up on the short term. So what about the long term? Do we have something? A few. Okay, a few. That was the point. Okay, that very, very, very few, and notice how it's everything energy related. Very, very few of the market instruments may be valid to do the type of trade that we want to do. So I'm going to have to be very, tolerant and flexible with the rest of the parameters, because I want to rely on the sector, guys. You have seen in the past how the sector can really, really help. An example was Verizon, isn't it? So I don't want to get stocks just because they're stocks and hope for the best just because I sold puts below price. I want to make sure those stocks belong to a strong sector, okay? Remember, stocks are fragile, isn't it? So anyway, so I got that. Okay. Now, if I add my penny increment options, which by the way, I need to update that file. There are stocks like, for example, Facebook, which now are Meta. So, and all of this is not updated. So I need to work on that one of these days. Not critical or urgent, but indeed I want to do that. And basically, so this is my list. So I'm working with just a bunch of, very, very few stocks. So what would I want to see here is I would want to see those stocks to show earnings not too soon. Okay, exclude the next 30 days, hopefully. Okay. Oh, okay. So my list was very short because I had some earnings condition. Okay, you know what? That's giving me a little bit of relief. Still, everything is energy related. So I got a few more. Good. So those don't report earnings in 30 days. Okay. And then I would want to see those stocks, ideally, to be very late, to have an auto climate down, which is very late, like super crazy extended to the downside. Okay. And those we got two, DVN and LNG. Okay, they are not the most liquid stocks in the world, so I'm just gonna go hopeful. Should have a few more. That's better. Okay, so again, I'm trying to be flexible with the parameters because again, I don't have that much to choose from today, right? So those are stocks that belong to a strong group that have been, falling aggressively in a way where statistics suggest that's enough and it needs to come back up at some point, of course, depending on many other factors. What else would I want to see? Well, ideally, I would want to see some bullishness coming in from the options data. Okay, I would want to see some bullishness coming in from the options data, as well as I would want to see some of those stocks to be in speed bumps of support. So we don't have any inside of a speed bump of support. Okay, so that doesn't make me happy. Okay, but again, there may be speed bumps of support below price, so I'm going to have to check for other parameters. Okay, so let's look for top positive CIV spread. So we are looking for implied volatility of the calls greater than the puts. We got a few. So there is some buyers coming in some of those stocks. And ideally, to do a better trade, I will want to find high volatility conditions, which is going to be implied volatility mean greater than 80. Do we have anything? No. What about implied volatility greater than 2 standard deviations? Yes, we have a few. Okay, so there is some premium in those. So let's take a look at, we'll look at Oxy. Okay, good. So let me see. The daily time frame providing 57% probability. That's pretty good. So we are looking at speed bumps. If I project from here, there is a speed bump coinciding with that. That's good. If we project from here, there is another speed bump a bit lower. Okay, but we are not there yet. Okay, so yeah, so I guess that it would make sense with a 57% probability with those UFOs. It would make sense to rely on that 49 strike. And let's see, using the option chain, also earnings are happening on 802. Okay, 802. So let's take a look at August 19. So if we look at Oxy, so August 19, and we look at 49 strike, we don't have 49, we have 50. I would say good enough, even though the difference is $5 at a time, so that's not ideal, but anyway, is what we have. So the 50 is trading at $3.30 from 3.30 to 3.15. It's pretty nice, pretty liquid. Let me take a look at one more extra note of caution, because again, we are dealing with pretty dramatic market conditions. I would like to find out more about open interest. Let me add edit study options volume map. I want to add numbers of month out. I want to go all the way to August, which is here. And now we can see how there is a pretty significant open interest at 50. Okay, pretty significant open interest at 50. So that, that makes me happy. Okay, we have pretty significant interest at 52 and a half. So it's going to be difficult for the stock to go below 52 and a half. And it's going to be even more difficult to go below 50. There is another pretty big pocket of open interest here. So I'm good with that. And therefore, I would like to give this trade an opportunity to work using the 50 and the 45 strike. So if we sell the 50 and we buy the 45, we are creating a spread with 131 dollars of credit. If we do that twice, of course, this is going to be a $1,000 risk trade. So we are creating $2.64 dollars of credit. So the question is, what can I buy with that credit? 260 something. That would allow me to buy. Yeah, it's not going to work. Yes, I really don't like it. We're gonna abort the plan. We need that stock to drop a bit deeper. That's why it's very nice when you do the filtering, that those stocks are inside of a speed bump. Okay, when those stocks are inside of a speed bump, it means normally they have felt a bit more, and then you get more premium, and then things normally work better. But okay, sorry, right here, that's what I was looking for. So that 50 UFO, we just happen to be just a bit too far from it. Okay, so if this was inside of a speed bump, it means it felt a bit more, and then the trade may work. Right now, the reason why I'm discarding it is because with 260 something, the only option you can buy is like the 70. Okay, and that's gonna give you very, very, very tiny amount of delta overall, and I'm not into it. Okay, so I would prefer to have something a bit closer to the current price. Of course, just to give you food for thought, something that you could do is to use this credit to buy a call butterfly. So instead of buying a call, you could buy a call butterfly, or you could buy a call spread, which are cheaper alternatives. Also, of course, they are cheaper because they have less delta too, but they may give you more flexibility for certain things. So I'm pretty positive that we'll have opportunities to explore that as the market keeps falling, because the climate suggests that this is going to happen, and in future sessions we'll be able to address that. Okay, yeah, I need to take a sip of water, guys. Sorry. Sorry, guys. So anyway, so we will abort here the plan with Oxy. In any case, hopefully the process I was following is a good guide for you to do a bit more research, a bit more practice, look at more symbols, look at more setups. To be honest, this setup looks beautiful, nice UFO, grace probabilities. It's all beautiful. We just need a bit more premium. So patience. Let's have that stock fall a bit more, and then it may work. My friends, always a pleasure. For the ones of you that joined a bit later, I would like to show a message on the bottom part of the screen one more time. In case you didn't know, we are launching our crypto course on July 9. It's a 7-day course that we're going to run online for the first time. There is a pre-launch promo, pre-launch everything, and you can get access to this by going to our courses page. And when you click on the crypto course, you will see that you have a drop-down menu with multiple choices. If you choose the date, July 9 to 15, you get that 61.8% Fibonacci retracement discount. And yeah, hopefully that is good enough for you so you can join us on that week. It's going to be very exciting. We're super excited to finally have a digital asset course. It's beyond cryptocurrencies. We'll touch about all the digital assets such as NFTs, DAOs, and everything else. So hopefully I will see you there. And in the meantime, keep up the good work, everybody, and see you in the next one. Bye-bye, everyone. Take care, my friends.